When is the best time to try to improve your credit score?
You should be in a constant state of always being mindful of it. In the same way that you would guard your social security number, you should always be cognizant of your credit score. Poor credit scores are money vampires.
Today's episode, I have a good friend of mine, Mr. Derek Roban. He is a father of two. He is a husband to a beautiful wife. He's a mortgage advisor for Preferred Lending Solutions. Is it Preferred Lending? Did I get the name right?
You did.
Cool. He's a coach, a stage dad, a podcaster, all around good guy. He's the designated guy who holds me back on the sideline of the soccer field so I don't get arrested. Derek, welcome to the podcast.
Thanks for having me, Chaz.
Bro, it's so funny. All right. So Derek and I have coached together on a soccer team for many, many years now, where our kids are playing select soccer this year. So we go out to the field, and now like we just bring a lawn chair. We don't actually have to coach because they have like private coaching. And Derek's like, look, I see my old buddy Chaz. Let me go tell him hello. And he walks up and we start talking and say, by the way, Derek, we're going to be running every time we have practice. Yeah. And not only are we running, but we're in a 100 push-up challenge where we do 100 push-ups a day. Are you in? And he's like, I guess I need to get back in shape. Yeah. 30 minutes later, he was in the group text, and ever since then, 100 push-ups a day.
100 push-ups a day. I've missed 2, by the way, so I got to catch up.
Was that at the beach?
One day, and I think like day 6.
Yeah.
Yeah.
Have you noticed any difference?
I have.
Yeah. I've noticed it.
I have.
Yeah. And I noticed in my core, I noticed it like, so the challenge is you just do 100 push-ups throughout the day. You could do them, knock them out all in the morning, the evening, whatever, 10, whenever you think about it. And I think it's been a good thing.
So far, I've stuck with it. I haven't stuck with a lot of things lately.
Yeah.
Because usually when I would do those things, it was always within the constructs of like a team, or a group. And we do have a group. It's virtual now. So yeah. I'm proud of myself.
Yeah, good job. Well, rates are coming down.
They are.
Yeah.
I locked my first refi in like 2 years yesterday. That
Wow.
wasn't the result of a divorce or a death.
What does a mortgage advisor do?
We wear a lot of hats. I know I wear a lot. I can't speak to what everyone else does, but had a great mentor. The way that I run my business, my practice, whatever you want to call it, as long as there's extreme ownership, that's really all that matters. But the thing that really shaped me was who I learned from and my experience the first time that I bought a home. I went through a national online lender when we bought our first home in Texas. They brought me to tears twice. Not because I was sad.
You're just sensitive.
I was angry, like Rage Against the Machine angry, like it was bad. So just through the benefit of being able to look in the rearview mirror when I started doing it, that was always kind of the core tenets of what I wanted things to be, was all based off of the way that I felt whenever I was on the other side. And I swore to myself, I didn't want anyone to ever feel like that. So what do? We do financing for homes, obviously. A lot of people quote rates and take realtors out to lunch and take pictures for closings. That's all part of it.
I thought that was the only part of it.
That's probably the only part of it for a lot of people. Some are really good. Are there people better than me? Yeah, of course, there's always somebody better, right? But I take a more holistic kind of approach to it. So I do have a background in financial advising out of college. And then I think when I turned 30, I was never a reader. A switch flipped where personal development kind of became a thing. So I consumed a lot of those things, and including for finance, like over and above what I had learned in school and done professionally. And really just digging deep, right? Like someone comes to you and they need an attorney, you probably ask them a lot of questions.
A ton.
So mine are a fewfold. One is obviously it's through the context of purchasing a home. Part of it is through building wealth. That's a big focus for me. And another one is, you'll laugh at this because I often use an analogy that I am kind of like their attorney. Lending is hard. It's confusing to people, even if you bought 5 houses. You just don't do it often enough. You know, it's kind of a use it or lose it thing. But the way I explain to people like what my role is, think of me like I am your attorney. I'm going to ask you a lot of questions. I am genuinely curious, but I'm filtering information as you're telling me, like, hey, we're not, and the underwriter, right? That's who ultimately issues final loan approval, where wire transfers start happening at title firms and people purchase homes. The underwriter is kind of like the judge, right? I am presenting your case as a borrower. You are putting up collateral to get a loan. I want the verdict to be that you're approved, right?
That's a good analogy.
So you're telling me things. Okay, that's important for me to know. I'm glad you told me, because this would have blindsided us later.
Right.
Tell me the second thing. We don't need that.
Good piece of evidence. You're filtering.
Need to know, oh, that's going in the shredder. You didn't tell me that. You know, all that stuff. So that part of it, the wealth building part's important. You know, people, the only thing that people typically know what to ask is what are interest rates doing? What is your interest rate? And I never, ever, ever answer that question, because it's so layered. What are you trying to do, right? Are you a veteran? Because maybe we'll look at VA. Are you buying a rental property? How long are you going to be in the house? You know, my conversations with people who are moving up the corporate ladder every 3 years and sell their house every 3 years, those are way different.
You're trying to minimize the extra cost that each group has depending on their goals, because the person that might be out of the house in 3 years,
that's right,
doesn't need the same tool as someone that plans on living there 30 years.
Correct. Yeah. Correct. We have different tools in the toolbox, but it's not just about interest rates. It's about what loan strategy is going to suit you best. And then we combine that with how do we put the best purchase strategy together with your realtor, right? Efficiency of funds. I don't want you to look back 3 years from now and say, hey, I wish I would have done this, or I wish I would have done it that way. You know, we have I have some excellent software that will look ahead into the future. You know, nobody has a crystal ball, but with math, you can project. So my goal is always to say, hey, look, here, you're buying a house, obviously, right? Here's your point of sale stuff. So you're thinking, well, like, point of sale, what are you talking about? What's my interest rate? What does my payment look like? What do you estimate that I need to bring to closing in dollars? So we look at that stuff, but we'll look at different strategies and say, hey, look, if you buy the house like this, here's what this looks like 2 years from now. So I'll show people different options. Some of them at point of sale look a little sexier on paper, right? But if we look out into the future, it may be a more costly option.
Yeah.
So we don't just focus on the price of the house. It's more of a 360-degree deal where we look at, like, hey, which one's going to cost you the least amount of money, because there is a difference.
And some, not to throw anyone under the bus, but there's some brokerages that probably say, okay, how do we get this person in a house?
Yep. And
how do we make the most money in that transaction?
Probably.
Yeah.
Probably.
And now what's the best actual tool?
Correct.
So you probably have a pretty specific customer, because the guy that comes in, the same guy that goes to the used car lot and says, hey, what's my monthly note, right? And they're not factoring in any other thing. Mm-hmm. That might not be the best customer for you.
We'll talk about it, right? That conversation evolves as the minutes pass, and sometimes that's really all that they're concerned with, and and that's okay. But just I would be doing them a disservice if we didn't try to uncover all of their needs. One of the way that I have the conversations as well is, okay, what's the number one thing you're trying to accomplish? And it's kind of a rhetorical question, because I know the answer. Hey, I'm trying to buy a house. And then so I'll give them examples. I'm like, hey, look, okay, so there's 8 things you really want to have happen while we go through this together. What's number 1 though? Because if I do 2 through 8 and we can't do number 1, then you won't be completely satisfied. Now, if I find that we just can't, but we can do everything else, I'll let you know that up front. But I at least want to get number 1, because that's the most important thing to you. What's the most important thing?
Would you say that so you're basically trying to put people in homes and obtain financing for them to buy their home, whether it's an investment property or residential, or if it's their home that they intend to live in, a second home, whatever.
Yep.
Does it really come down to a function of credit score and cash on hand? Is that the two main drivers?
Credit score, what funds, if at all, do you have available for closing? And then purchasing power. What does your income look like? And that looks different for different people also. Like, hey, nurses are my tightest referral group I've found over time, I guess because they work in close proximity, high stress environments, weird hours sometimes. And, it was really interesting when the interest rate environment increased. I have a nurse named Sarah might come, and she bought a house and her payment was $1,400 a month, and then Emily comes back the following year and says, hey, I want to live next to Sarah. And I say, okay, well, cool. Your payment's $1,900 now, and she didn't say it, but you're thinking like, well, do you like Sarah better? And it's like, no, that's just where money is right now. But it looks different for different people. Okay. I've had couples make multiple 6-figure incomes with no children that could afford a $550,000 house. And then I've had single people who make like $90,000 but have no debt and can afford the same amount as the other people. So it's a balance of what do you make versus what do you owe. We don't look at total debt. We look at payments that show up on the credit report.
Interesting. And so credit score is very important.
Credit score will determine your financing terms. So people with low credit, we have to check all the other boxes also.
And when do you find that, I'm sure you give some counseling, I think just based on some conversations we had on,
Sure.
on how to reduce credit score. When is the best time to try to improve your credit score?
You should be in a constant state of always being mindful of it. In the same way that you would guard your social security number, you should always be cognizant of your credit score. Poor credit scores are money vampires, straight up. Like maybe you go get a new iPhone at AT&T or Verizon, you can't get on the payment plan. You have to pay for it up front. They're doing that because they're doing a soft credit check on you to see if you're going to be reliably be able to pay that phone, that monthly installment with your service. That determines whether or not you put down a deposit when you move from place to place for utilities or water or cable or whatever. I've seen some people with vehicles at 19% interest rates.
Wow.
Started seeing the car notes in the $800-900 range. I'm like, wow, you got a Lexus or Mercedes. They're like, no, it's a Camry.
Can I add another one? Auto insurance.
Yeah, that's another one.
Auto insurance runs your credit score.
That's
They've
right.
challenged that. And
Yep.
Your financial responsibility also could determine your ability to drive.
It does.
Right.
It does. And that's an interesting conversation to have with a borrower. Okay, we got insurance information from the seller. They're saying insurance is this much, so I'm going to expect that. And so, well, let's prepare for it to be higher. We don't know what their insurance rating is because people usually don't know they have an insurance rating as well. Maybe that person's credit score is 150 points higher than you. Maybe they're 15 years older than you are. There's tons of things that come in.
So if you were talking to one of my clients and you had to give them advice on how to start improving their credit score today, what would you say?
Pay your bills on time. That's the big one. The one I find that trips people up the most is they'll ignore things that come in the mail. Like, do not ignore the mail. Pick up the phone. Just as a best practice for myself, I pick up the phone, and whether I want to pay something or not, typically it's medical bills, right? Like you go to the doctor, you get a $30 copay from the dentist or the physician, and you get a patient responsibility thing. Or they say, hey, we're still processing insurance. Let me see if we can get rid of that part. I just pay it anyway. Ultimately, the accounting catches up, but those will hit people. What are some other ones with the first-time home buyers when they leave an apartment? And they go to another apartment before they buy a house and they don't turn in their cable box. We see Cox Communication judgments all the time. Borrowers are real steadfast and matter of fact about not paying it. Like, I'm not paying that, to heck with those people. And I'm like, well, it's to heck with your credit score. Your stuff is perfect except for that.
Wow.
Oh, by the way, you're 24 years old. Like negative items or negative credit events impact have a greater impact when you're younger, because the length of time your credits has been established is less.
So it's proportionally higher credit, proportionally bigger liability based on the number of years you've been on Earth.
That's correct. Right. So I'm 43 years old. If I have a 30-day late on a credit card, it's going to impact me this much, still negatively. Right. If it's a 23-year-old, it would be this much. So their score would drop by quite a bit more.
What about credit cards?
You should have one. You should maybe have two. So there's 5 things that determine a credit score, that make up kind of how the scoring system works. The captain obvious one is you have to have on-time payments. One of them we just talked about. The second one would be the length of time that your credit has been established. So all things being equal, someone who's had let's say a Discover credit card account for 20 years and everything else is the same, their score is going to be higher than someone who's only had one for 2 years. Credit mix is important. And this is where I think some of the younger generation is a little bit underserved, probably from guidance from the internet, maybe from parents who trying to do the right thing and, protect their kids, from mismanaging credit cards. We've all done things that we wish like if I would have known, I wouldn't have done that, but preventing a child from getting a credit card, all it does is hurt them. And if you don't want to give them a credit card, one way to increase a credit score is to get someone added as an authorized user on your account. So, I have a 23-year-old guy right now. He's got a 787 credit score. His parents had him open one when he was 20, and they attached him to 2 of theirs that they've had open for 25 years.
Thanks, Mom and Dad.
Totally gets to ride the coattails of all. So I pull up the account. It looks like he's had it since 1991. The dude was born in 2001.
He piggybacked on his mom and dad's open credit card for 25 years, even before his birth.
Correct.
Wow.
So
you had number 4, I think.
Yeah. The new credit. So if you've had too many inquiries, too many new accounts, the more that you have in a short amount of time, the riskier you look.
So be careful on that Home Depot and TJ Maxx.
You probably shouldn't be doing those anyway.
Okay.
Right. All things being equal, you want a versatile option. So it's just a standard Visa, Discover, MasterCard. You can use them in more places. Store accounts are not, it's the inferior option out of the two. So when you go sign up for a card, like I'll get asked all the time, and they'll say, "Hey, would you like 5% off for your purchase?" I was like, "For 60%, maybe." And then I'm going to leave the checkout line because I'm about to go buy some more stuff. Make it count, right? But whether you get approved or denied.
Are you saying that that's a lot of consumers' psyche? They'll see that 5% and it'll, I realize you were making a joke, but do you think that 5% encourages more people to spend more money?
For some.
Yeah.
If
you've seen it all.
If you're spending $100, why would you burn a credit inquiry for a $5 savings?
Well, good point.
I wouldn't. No, if I'm spending $5,000 and I get 40% off, that's different.
Yeah. But Lathe will tell you the Amex will give you that anyway, right? So why get the Home Depot card?
I think the big thing that the consumer cards have switched to is really just the point systems. The frequent, not the frequent flyer miles, but to incentivize you to keep shopping. And eventually the psyche is, well, I'm going to go to Target today or wherever, right? And get $200 worth of free stuff. Well, it's not free.
No.
You spent a lot of money. Hopefully all that stuff that you spent to earn that $200 was worth it.
I want to talk about that in a second. What was number 5?
I always forget the 5th one. Oh, credit utilization. So the quickest way, if you have a credit card, so here's, not only do credit cards help increase your score, so is because if you have a credit utilization means lines of credit versus installment loans. So a lot of times we'll see people with payday loans, vehicle loans, student loans. Those are all money that you owe where there's a fixed amount owed every month. Just because you have a credit card doesn't mean you have to use it. You open a card. I have 4 in my wallet. They each have a specific purpose and I use them. Right. But if I didn't use them, I could have 4 and just keep them. I only owe money if I use it, right? So if someone only has loans and they have 0 credit cards, then their credit mix is off. And that's 20% of how your score, it's one of the 5 components. So one of the fifth one, credit utilization, is how much do you owe on your lines of credit? So that can be a HELOC on a house, a home equity line of credit, but predominantly it's credit cards. What do you owe versus what is your limit? The magic number to start getting tangible benefit in your score is typically 30% utilization. So if you have a $1,000 limit, you want to keep your balances $300 or less. The lower you go, the higher the score goes. I get credit monitoring on my credit cards. Mine does like this, depending on when my statement's cut and what I owe at the time.
When did this is completely unrelated, but I wanted to ask your opinion. When did it become the norm for businesses to pass on credit card fees to the consumer?
I'm not sure, but I'm starting to notice it a lot more. I
they
think
do it. Some companies do it on the slick too. They're like,
Yeah.
cash or card. That used to mean like, do I need to put the prompt in the front,
right.
and for you to stick your card in or not? I think they added another charge.
I think
COVID.
it's psychology. It's gamesmanship. We're come eat over here, right? Our food's not as expensive. Well, it's not, but then you have all the add-ons.
Right.
Right. What do you get more upset by? Death by 1,000 cuts, or that you feel that you overpaid for food? And that's going to vary from person to person too. I mean, I'm not a fan of it. It's just the cost of doing business. Like in my mind, like make the burger go from $13 to $14.50.
Right. They're going to put it in somewhere,
Right.
but something about that 3%. It's like, man, they used to eat that as a way to get people in the door. Look, we have these other forms of payment.
Right.
Yeah, it annoys me, and not to mention the tip system that we've developed. Like, you check me out at Chipotle or Starbucks or whatever, and you got a tip line. It drives me crazy. And I tip. That's the worst part, because everybody in the store is looking at me like, "Are you gonna tip?" I'm like, "Yeah, here you go."
Yeah. Oh man, that's a loaded conversation. Yeah, I'm super sensitive about that. In college, I waited tables.
Okay.
Started at the bottom.
So you're empathetic, but you had to work for your money
to an extent.
Right.
I mean, I worked my way up to Ruth's Chris around here. That you could call that amongst the pinnacle, of the profession. But man, we worked.
Yeah. For that 20%.
If I wasn't nice, I didn't get paid.
Yeah.
If I didn't take care of the people's children, I didn't get paid. If I wasn't nice to the guy's wife, I didn't get paid. If I wasn't respectful and polite, I didn't get paid. If I forgot stuff, I didn't get paid.
Yeah. What if you just rang up the cash register and then you flipped out around
That's
the
right.
square pad and you're like,
so
5, 10, 15, 20%. I'm like, are you kidding me?
I started noticing that through all that, like the fast casual stuff. And I remember a couple years, and I just felt like I wasn't being nice. But one time we had gone into a place, the bill was $50, $60, $70, and it was a place we hadn't been. And the tip prompt came up, and I was like, "Hey, is someone going to be serving us?" And she said no. And I was like, okay. And I think that was the first time that I skipped over it. And, it's a lot more pressure too, because with those, you're right in front of them.
Right.
At least at the restaurant, I would drop something off, thank them for coming, hope they enjoyed their evening, then I would walk away.
Right.
I wasn't standing over them.
Right.
So I'm definitely not a fan of that. But I guess I'm old school in that regard. Like if I go to a restaurant and I have a great service, I can appreciate it because I did it. But those people are I'm not paying. That was part of the incentive to perform.
Right.
This stuff is just doing basic things.
I mean, and they're hourly employees. It's not, at least as a waiter, you were making half a minimum wage or whatever, and we're tip based.
$2.13 an hour.
$2.13 an hour. Like if you're working the cash register, I would assume that you're getting some kind of, fair hourly rate. And I've heard places that they don't even pass the money on to the employees. That's just like some extra cush for the business owner.
That doesn't surprise me.
Yeah, that's crazy. I've heard that from a few places in town. I'm not going to name any names, but
Right.
yeah. So I had a cyber lawyer on, and she talked about locking your credit.
Mhm.
Are you familiar with this?
I actually need to do it. I do have a couple of clients that have purchased multiple properties where, like if they hadn't bought in a year or two, I'll forget, and I go to pull and I can't pull. So it works.
It works.
And I just call them like, hey, I need you to unlock all this stuff.
It's super easy. You just slide a button and it unlocks it. And she actually said you should do it on you and your kids.
And your kids. That's right.
Because, I mean, it seems like every other month there's a data breach.
Mhm.
And you know that Social Securities are running, like Lay said, in Russia somewhere.
Yeah.
And they can open up credit cards and all kinds of stuff.
And I think if you do it with one, it does it for all of them. So, for example, if you would call, it's Equifax, TransUnion, Experian, it's my understanding if you do it through one, it does it for all of them.
So, Derek, we talked about like the 5 ways that you can improve your credit and like the timing. So you think that you should start doing it now. Do you find that when people first start thinking about it, they're already in the market and trying to buy a house and they wait too late?
People usually, the order of operations is usually flipped, right? They'll connect with a realtor, they'll start looking online, they'll get really excited. Sometimes they fall in love with the house, and then they work backwards to see if they can actually do it.
Can they?
Some people.
Yeah.
Some people.
You can throw some cash at things and make. And
sometimes people are ready. We have to work backwards. Like, hey, I want to put an offer. We're like, look, we need to do an app. Send me documents. Sometimes it's so obvious, or people are buying so below the level that they can actually afford, kind of like their max purchasing power, that we can move pretty fast. We can still move pretty fast. Really, everything's digital now. Email, text, document upload portals, mobile home loan applications, stuff like that.
I really respect how you go through all of these financial documents. If I have to send a P&L or a financial statement, like my eyes start crossing, and then you're asking for electricity bills and all kinds of like there's so much minutia, man. And it's like you have a good way of just juggling all that stuff.
I think it's a product. It's everyone's brain works different. It's a product of how fast you can connect the dots in your mind, what your training is, what your education is, what you're interested in. We get title work in. So, I mean, we deal with real estate attorneys. We get title work in. I don't look at that. I mean, I do, right, to an extent, but I'm just like, I know you've had
send that to underwriting. Let us know. They'll find out any issues.
Well, I'll put the ball back in there. Like, don't just send me title work. What are the highlights? Are there anything on here that needs to be remedied or requires further curative work?
Yeah.
Don't make me look through it. That's not what I do. Like, you got paid to do that. Come tell me. Right. So if they have questions about the closing disclosure at the end, and we're talking about money and we're talking about the loan, I don't just send them stuff and tell them to figure it out.
Right.
We'll go over all that stuff, but everyone's different. So you look at legal stuff and you just breeze through it. I can't. You look at the stuff that I'm talking about, my stuff, and then you get caught up.
Yeah.
Right. I have a degree in finance. I do numbers all day. I look at tax returns and like balance sheets too. There is a difference between an accounting brain and a finance brain. It doesn't work.
Yeah. I look at Kevin. Kevin's a mathematician. He knows how to divide by 3 or multiply by 3. That's the only math lawyers know.
It just takes a little bit longer. And I think maybe it's a product of, you just get busier. You need to be hyper efficient with time as life gets more layered and not complicated, but just full.
But in the heyday, right? When it was rolling, when you had 2.5, when everybody was at during COVID, when everybody was refinancing at 2.5%, 3.7, 2.75, 3%. Dude, you were probably working 10, 20 cases at a time.
I think at the peak, I had 48 lock loans at one time. Yeah, it was. I think there
Did,
was a
did your wife have any access to you whatsoever?
not really. Yeah, I think
This is a season in our life, honey. I'll
I
see
tell
you in
this
6 months.
pretty much. I tell the story a lot. I think there was it's blurry, but there was 4 or 5. I think it was 5 days in a row where I worked like 19 hours.
Just on the phone.
I had to get caught up before the phone started ringing the next day. Otherwise, it was going to be so insurmountable.
These are refis mainly, trying to take advantage of the interest.
Yeah, I mean, I did 114 purchases that year. So for me, it wasn't. I was still I think 65% purchases that year, and those are a lot more labor intensive.
And then you figured out you got to make hay while the sun shines.
That too.
Because what happened?
And people who do refis typically have it together,
Yeah.
right? Because that means they've already purchased a home.
Right.
So unless they completely fell apart, our life dealt them a bad hand after they got in the house initially. They generally, and people actually, like when people buy their second homes, their financial profile almost always completely changes. Almost always. Credit scores are higher. They're managing debt differently. I see one car note instead of two, or none, which is fun because then they get to buy a lot of house.
But yeah, that season you were in your life, I use that term all the time, seasons,
Yep.
because that helps justify sort of, look, this is temporary. I gotta focus on this area at this point in my life. Interest rates skyrocket at post-COVID, right? The inflation gets out of hand, interest rates go nuts and to the upside, and then all of a sudden it's crickets, I would imagine.
Oh yeah.
And then you're like, man, when I was doing 48, I was miserable, but that doesn't seem so bad right about now.
Yeah. Yeah. That was the peak. I think I actively managed somewhere between 26 to 35 for about a year and a half after that, which is still a lot of working.
But
so,
I was watching this guy that I follow on TikTok, and that's famous last words. I heard this thing on TikTok, right? But he made a lot of sense, and he was like, look, and it goes back to marry the house, date the mortgage. And it's like, look, when interest rates come down, the prices of homes go up. So it looks like rates are going to continue to come down because inflation has cooled some, or they need to boost the economy.
mm-hmm.
And when these rates come all the way down, don't wait. Don't wait till the rates come all the way down, because the prices on houses go skyrocket. And I think we're already dealing with sort of a shortage of homes for certain segments.
Yep.
Talk a little bit about that.
So simple supply and demand. Rates come down. A lot of people have been sitting on the fence for 2 years. Some of them are slowly starting to jump off for various reasons. But yeah, when they go down, so for every 1% drop in rates, full 1%, it's projected that 5 million homeowners nationwide jump off the fence.
Wow.
5 million. So,
meaning they're going to the next home?
Meaning they're going to start looking for houses.
Wow.
So that's sellers finally not feeling like they're trapped and going to purchase the next one, which frees up inventory for somebody else to come by.
Yeah.
That's people who haven't bought that finally do it. Whether they do it on their own or they've been, their parents have been holding them hostage and telling them not to do it, which is bad advice, by the way. We can talk about that in a second.
I want to hear about that.
Yeah. So we're kind of at a sweet spot right now, so elite level credit for conventional loans. So that's just plain Jane vanilla bank mortgage, people with 3 to 5% down minimum, good credit. Those people are in the low sixes right now. But
which historically is not bad.
It's not, we were living in an alternate reality for a couple of years.
I mean, if you told that to people in the 80s and they'd be like, can I get 4 of those? Like,
yeah,
they were at 13%, 15%. Like,
with the way that things are going now, I feel like it's a sweet spot because they're down, but sellers are still giving incentives to sell their house. Okay. So maybe you have a seller who's selling for a certain price, and then they're like, hey, well, we'll contribute $10,000 towards closing costs and prepaid insurance and taxes that you have to bring at closing. People who have it, who have the stuff that they need, whether the loan requires a down payment or not, but they have their closing costs and insurance and stuff. What we're doing with people like that, and when we get incentives, now I have people coming to closing with no money, right? Or they come with their down payment, their closing costs, and then we take that $10,000 or whatever the seller's offering, and then we purchase a below market interest rate for the client.
You buy down points.
Buy down points. Okay, so what they do, they come to closing. I joke all the time because I'm very social. You know, you'll get a hug and a high five from me. I love closings. That's the party for us, right? You get a house, but then you get a seller funded refi at closing, right? So if this person is maybe at 6.25 at closing or whatever number, right? But we get it down to 5.25, and then interest rates drop, and then people's Apple News feeds start blowing up. Their parents are like telling them, hey, rates went down, you just bought a house. They see Bobby at the gym, right? Sarah goes and has coffee with her friend. Hey, you should refi. When we get for people who are doing things now and the contract is negotiated, you know, you have to have the right seller, right? You have to have a good realtor to negotiate the contract for you. And we work kind of holistically to say, again, we talked about the perfect purchase and loan strategy, not just the interest rate. But when we put all that together, those people that have helped purchase in the last 2 years, those people get to go and tell like their friends and their family that are telling them to do that, like, hey, I'm already there, right? So we future-proofed them against a refi that the seller paid for when they bought the house. So if rates go to 5.25 and they're at 6.25, they're already done. It's not going to make sense for them to do anything until maybe they get to 4.75.
Right, because it's more money to refi, right? And it's more time.
It's extra cost.
It's extra cost,
right? But you have to be in the money, you know,
right,
to use a.
It has to make sense. It has to make sense
because there's cost associated with it.
Right.
A refinance is an exercise in spending money to save money.
Yeah.
So, in the same way you spend money to make money, if a business makes an investment in some equipment, they got to know that they can generate enough revenue to cover the cost. Eventually, it's pure profit.
I remember I had a talk with you about one of a rent house I have, and we looked at it, and you're like, look, the benefit is a wash.
The juice wasn't worth the squeeze.
The juice wasn't worth the squeeze. So we can't spend real cash today to save.
You can't.
Nominal.
There's expressions, I forget what they are, like you step over $1 to save a dime. Like it just wouldn't have worked. What's important is you have to have somebody who's honest enough to tell you that.
Right.
Right. And I belabor that point.
Yeah, that's a good point.
All the time, because and some, like, mathematically, for people who have low loan amounts, they'll come for a refi, and I'm just like, look, I would love to do it, but it would behoove you to save money doing this instead. Yeah. You know, and there's some value to that, a lot, because then they know, because I tell people all the time, like, look, I only get paid if I help you. And I would love to help you, but there's better ways to do things. There's a better use of your money now. I think it's just good business. It's good business. We're talking about that with the guests before you. Like, look, we have conversations with clients all the time. We give them a free consultation, and we tell them, you don't need a lawyer to do this. And that's just good karma. It's just good business, you know. It is. It comes back around. It comes back around. Is it quantifiable? Maybe. Do you know when it's going to happen? No. Yeah. But you just got to know that if you're doing the right things, good things will happen, whether it's for you or for somebody else, or both. What about the people on the sideline? I'm thinking about the meme with the skeleton, like, that think that they're going to buy a home at like pre-COVID prices. That's not going to happen. Ever. It won't. Ever. It won't. Show me the $200,000 3-4 bedroom house in Youngsville or Lafayette, please. Well, they still have houses in that $200,000, that $220,000 range, but now it's 350 square foot less. Now that has no brick on it. Right now it's not a 3.3, it's a 3.2. Wow. It's not a 4.3, it's a 4.2.5. Yeah. You know, the costs the lots are getting smaller. Didn't you get like some kind of crazy, aren't you like a success story, like your house? How so? I don't know. Didn't you get it like a certain price, like that it's doubled in value, basically, like where you are? Like you found a sweet spot, right? I mean, there's a lot of people in Youngsville, Broussard, Lafayette area that. I would say, well, I got lucky because I do this for a living, right? So I was able to time my refi perfectly. You know, of a 15-year loan at 175. Like it doesn't, I can't even pay my house off early. It would be financially irresponsible to do that, actually.
Right.
Um,
But I know that people that purchased in 2017, 2018 in a good neighborhood.
Buying a house is kind of like trying to lose weight. Okay. Imagine it being January 2nd. You go into the gym and you're like, hey, I want to lose 30 pounds. And the trainer says, well, look, you got to eat this much food and do this much activity based off your goals mathematically. If you do everything right and we don't have any complications, you should have this much gone like by this amount of time. But nothing starts until you start. Okay. So for people sitting on the fence, to answer your question, if you don't start now, your appreciation clock never starts. So people 2 years ago who said, hey, I'm going to wait 2 years. Well, guess what? Their $200,000 house that they wanted to buy back then, but said no because it was too expensive. That house is selling for $215 now.
That quick.
Yeah.
And they didn't add any equity to. I mean, they didn't pay down any equity on the house.
That's right. So, you know, you put a down payment, you have this much equity. As you pay your loan down, you know, you build more, but then property appreciation happens. So it grows on both sides. So did I get lucky? I would say yes, because we found the house that we liked. We were one of the first 10% of homes in the neighborhood that we bought in, which ultimately has grown to be so popular. They're, I think, on their 5th phase now.
Wow.
Which is great.
Yeah.
But I didn't wait. I started and I let time do its thing, you know, and so I have built wealth through being a homeowner. So people 2 years ago that didn't buy and they've been paying, say it, just easy math, $1,000 in rent for 2 years. And they say, well, I can't afford to buy a house. I had this conversation the other day. I wasn't in front of a computer, so I used the same example. And he said, I can't afford to buy it right now. And I asked him how much his rent was going to be. He wasn't, his fiance didn't want him to move until he had finished nursing school, which he was 2 years out from. And I was like, well, it sounds like you can. He said, well, no, I can't. So what you just told me without telling me is that you can afford to burn $12,000 a month. That sounds expensive. Like I'm 20 years older than you. So I mean, just naturally, my income is higher. I can't afford to waste $12,000 a month. You know, so he said, well, what if when I get a job and we move, right? Then I'm going to lose money. So, well, you told me you had a little down payment. You're going to pay your loan down. It's going to appreciate. So let's say worst case, after realtor commissions and whatever you have to give to a borrower to incentivize them to buy your house and pay your loan off, that you have to come to closing with $1,000. Because that's the thing, by the way. Some people have to show up with money to sell a house. Let's say you're upside down, $1,000. Do you want to lose $1,000 or do you want to lose 24? Because you can look back and say, well, it's 1,000 divided by 24, whatever that comes out to. And that's how much it costs you to own a house. That's pretty awesome. You know, and then if you bought 4 or 5 years ago, anybody that bought from, 2016 to 2020, like right before COVID, property values shot up. I mean, everybody's up 20 to 30%. A lot of people's wealth is trapped in their houses. You know, so you have people who don't want to jump off the fence. If you're living at home, I guess, it's okay as long as you're saving, right? To take that next step. If you're renting, you're losing money. It's not tax deductible. I've had somebody ask, well, hey, what happens if like I can't pay my bills? So do you think your landlord's not going to kick you out? By the way, they can probably do that in a month. At least you have to go through the foreclosure process. When you sell it, you can stay in it longer.
And you can scratch the money together and get right.
You can do something.
Because the bank doesn't really want your house.
Right.
They don't want to hold on to the house. They don't want to cut the grass.
That's right. So there's that. And then somebody said, well, but what if I can't? I get foreclosed on. I don't want to lose the house. I'd have to, I'd have to sell it. And I was like, why don't you just keep it? And so well, how would I keep it if I can't afford it? I'm like, look, I talk to way more people who are never, ever going to buy a house than I do who actually can be a homeowner and become homeowners. There are a lot of people that are paying rent right now to somebody. It might as well be to you, right? So if you fell on hard times, you don't have to move out and go back and live with mom. You can, but don't sell, right? Get a tenant. Because there's a lot of families now that have kids, you know, the wife doesn't want to live in an apartment. Dad's got to go find a rent house. Let them rent yours.
They're in for 2 years on an assignment, a traveling nurse.
A traveling nurse. And maybe they want to stay there forever. But 2 years from now, you get it back together. Well, guess who widened that gap for you as your home appreciated and paid your loan balance down? You go back in it. They've created, you know, 10, 20, 30, $40,000 worth of wealth for you while you were saving up money to get to that next season of life where you could go back.
Yeah. That's a great point.
You really never have to lose the house.
If I have a client who comes into a windfall of cash, we're talking about 6 figures.
Sure.
Some of them want to buy houses. Would you recommend that they buy the house cash if they have the money, or still look into financing?
Very situation specific. Very situation specific. Some people, I'm sure you've seen both, right? A wide spectrum. You've had the good fortune to help a lot of people who needed your help. And some probably weren't homeowners at the time. They maybe won't ever be able to be a homeowner, meaning they probably also couldn't get approved for a loan without some sort of significant life change that would flip them from one camp to the other. For those people, they probably need to pay cash, you know.
Bird in the hand, better than 2 in the bush.
That's right. That's right. For other people, it's different. You know, I was watching one of your, it was a client testimonial. You had a young lady on who was talking about how you just didn't let her get the settlement. Like, you were trying to connect her with financial professionals, which resonated with me because, you know, we have a network of financial advisors, CPAs. A coaching group that I belong to talks about being captain of the wealth team. You know, because again, I look at it holistically. So if I'm getting TurboTax returns, but I see people have pretty sophisticated income, pay somebody to do that for you, you know. But if they're averse to investing, why don't you invest in real estate, right? If you can get financing, you get $500,000 and you want to buy a $500,000 house and pay cash, you could. Or you could put down 100 and then go put down 100 4 more times, get a bunch of rentals. You know, when do you want to stop working? You know, I know this is tough work. Are you trying to pass this off on your kids? Is this part of what's your future plan? Like, maybe you want to grow the business to sell it, but you want some mailbox money. Right? Do you want to be a real estate investor? Like, the types of conversations and the questions that I ask, it really, and especially when people come in the chunks of money, don't do anything yet. Like, a lot of times people want to pay off a vehicle with a big tax return.
So you could also have that conversation with them and say, look, I can get you at 5%. All right. Historically, the market will give you 8 to 10%. It's not guaranteed, but it would make sense to not put all your money into the house.
That's correct.
And put some of it in the market or whatever. But it depends on the sophistication level of the client and their credit score and all that good stuff.
Yeah. Risk aversion, future goals. I would say another one would be.
But they still should have the conversation with you.
Oh, 100%.
You know?
100%.
Like, even if you have the cash, you should still have the conversation, and then you can tell them, say, no. You would be honest with them after 30 minutes and say, pay it cash. Yeah. Make sure you have enough to cover your insurance and utilities and go forward.
One thing, and people forget too, like, once you pay a house off, you still have housing expenses. You still pay for insurance.
As a man looking to replace 3 air conditioners, I could tell you, yes.
Yeah. So, I mean, if you think you're going to pay cash and not have any expenses for a house, you need to talk to somebody.
And the property taxes keep going up, and the insurance.
Yeah.
Here, hopefully we have a great hurricane season that we come out untouched, because, man, we need these premiums to go down.
I think we will. Yeah. We're almost at the end of it anyway right now. We're pretty fortunate. I had the unique perspective. You know, a lot of people never leave Lafayette. We bought our first house in a suburb of Houston. The property taxes over there every year.
Bam.
Like crazy. It got to a point where our homeowners insurance and tax escrow was higher than our principal and interest on our payment.
A friend of mine said, you think you own property here, but you're really just leasing it, because if you don't pay your property taxes, they're going to take it from you.
That's right. So that would be a reason. Throw some in emergency savings. A lot of people are like, well, hey, I want a low note. Like, what happens if I lose my job and I can't pay the bill? Like, well, that's what savings is for.
Right.
Go lock it up in a CD. If you don't trust yourself, go put it go be a co-account holder on a savings account with a parent, as long as there's some trust there, somewhere where you can't touch it. But if you have a slow month, or you have a bad month, or you have a bad handful of months, that's what it's there for. What I would tell you too, you made me think of something. I ran into it back in, I think it was 2018. When you stop utilizing credit, all of your scores go away. I think it's about around 3 years. Just 2 examples to share with your audience. One of the guys in the office did a loan for an attorney. Did so well, paid everything off, paid cash for everything. Marriage dissolved, had to go buy another house, no credit score.
Oof.
So we were able to do it. He had to have a down payment, which, he was well off, right? So 10% down, and he had an atrocious interest rate. But all the things that he had worked for over time. So you have to stay in the system, I guess is the point.
Like, yeah. Shut up, Dave Ramsey.
Yeah. You have to stay in the system, and even if you're not trying to buy things, what we talked about earlier, insurance, cell phones, like deposits on things, if all that goes away, it's almost like it never happened, which is bananas.
Lath, if you listen to Dave Ramsey, you're going to be 75 years old when you buy a house, right? Pay cash. Don't you love how the billionaires give all the financial advice, right? I mean, there's some parts of Dave Ramsey that's like spot on, like the waterfall method and the snowball method and some of his advice, but the whole not taking loans thing, dude, this country was built on credit.
Mm-hmm.
I mean, come on.
I had an elderly couple one time too, who theirs went away at the end because they had just gotten, so a lot of times I'll get a realtor will call and say, hey, I have a client who wants to pay cash for a house, older person, lady or man, couple, whatever. And I'm trying to tell them they should at least take out a small loan. All right. And that's how I know, like, when my realtors get it too. And that's part of that is just educating, like, here are the things that we see. Like, if you ever have a client like this, and even if I don't get them, like, advise them to at least do a tiny one, just to keep payment history of something.
Yeah.
Because if they ever need it and they don't have it, not because it never had it to begin with, because they had it and it vanished, that can be pretty unsettling. It's not, and it's really, really and truly, it's not fair either.
Talk to me. We got a couple minutes left. Talk to me about the podcast.
Podcast is going great. I would say that you had a big part in getting started. I remember I had reached out to you and told you there was something you had done in a reel one time where I think visually I had an idea in my mind. Visually, whatever you had done, whatever your delivery was, whatever the topic was, all of it kind of came together, and it was the embodiment of whatever I was thinking about, but I couldn't visualize it. So it was that's when I'd reached out to you. I came to watch one of your episodes, and how long did it take after that?
So you're already considering it before I dropped the podcast.
I was. I mean, I don't say it was an afterthought.
I think you might have had your equipment before me.
I don't know.
Yeah.
I don't know. I had it for a while and didn't use it.
You actually inspired us to beef up our cameras, so appreciate that.
Yeah, I mean, it's been a process, right? Things have changed, right? Everyone's on their phones. I always think about you when I see the billboards. I know you talk about it with the attorneys. I think I had a reel pop up. The guy was wearing a white shirt, was talking about billboards now are in people's hands.
Yeah.
So if you're not in front of them,
well, podcasting is the thing that you can multitask. You can listen to it while you're running, working out, in the car.
I think part of it is the personal branding part. I was listening to one the other day, and there was some study, I can't cite it, but it was millennials, which I'm like the first year of millennials, 1981. I always thought I was Gen X, but millennials, which is like 81 to 95, they were surveyed about branding, and 70% responded that they would rather get like a personal branding resonated with them more than like generic corporate advertising. So I think it's important. But it humanizes you. People get to see, you allude to it a lot of time. Hey, I'm a dad, a husband, I struggle, I have successes.
Yeah.
I wake up some days and feel like $1 million, and some days don't want to get out of bed. Like all of that stuff is real.
Right.
And I think it's important to share that so that people know that, so they know that you are just like them.
A person.
That you're a person. We're not robots. We have flaws. We have things that are really great. And it's important for people to see that. I think on my side, because loans are boring. They're a means to an end. They're a function. But as you've found out today, there's a lot more to it than just trying to finance something.
Well, I love that you're philosophical and deep. That hits me in all my fields. But I want you to plug your damn podcast.
So it's doing well. We just finished up episode 10. It's been a lot of work. I saw the stuff that went into yours. A lot of editing. I got super lucky. Not only did I somehow trick a beautiful woman into marrying me, she's also super talented with video editing software. It gave me the green light to spend over $40,000 on equipment.
So if you're thinking on get a podcast, if you're listening at home and you try to come take us on, 40 G's.
I think yeah, pretty much.
Every bit of it.
Can you do it? Can you do it for less? Sure. I'm at a point in life where, and I credit my wife. She told me, just get what you want and be done with it. Right. So we just went top tier. I'll never outgrow the capacity or the capabilities of the equipment.
No.
I'll never be disappointed with the output. We get to
what's the name of it?
The Nest Podcast.
The Nest Podcast, and that's on all platforms.
I haven't done any of the audio ones yet, like Spotify and Apple, but we are on YouTube. I regularly post clips to Instagram.
You don't post it on Apple or Spotify?
I haven't yet.
Oh, you need to, man.
I haven't yet. You should take me out to eat and we can talk about it.
You need to. Buzzsprout, Carter? Yeah. On Buzzsprout. And you bring on people in the real estate industry?
We've started out that way. I would say I've transitioned. The conversations are a little bit different. I don't want them to all be the same. It is a way to highlight realtor partners, whether I work with them or not, to kind of be a profile. I looked into doing things like, hey, what if I get a camera crew out here and I do an interview and some sort of marketing commercial type stuff. And it's expensive, right? So it's a way for us. It's a way to showcase myself, but also showcase the partner. We cut it up into clips. We offer deliverables so that they can use for marketing content as well. If they would do that as one-offs, it would be, a lot of times it'll get into the thousands of dollars. So I think there's something there. But you can only talk about the same thing so much. So I've found, you had told me something, have interesting conversations, but also like I'm wanting to have different ones now. Even considering branching out in the format where it's not just 2 people, maybe it's me and 3 other people. So do have aspirations of being kind of like a connector, like a round table, I guess more kind of like the really high end ones you see.
I can't do that with lawyers. Everybody be fighting for the floor.
Well, so part of kind of like the mix I wanted to do was really just have everybody be different.
Yeah.
Right. Have you on, have a realtor on, and maybe have a restaurant manager, just as an example. Everyone's going to be able to bring different things to the conversation. Truth be told, with that many people, with that many different backgrounds, I won't even have to look at a piece of paper.
Yeah.
It's just going to flow.
And it's funny because you always, like, you and I talk business sometimes. It's like we're in completely different industries. We have some of the same struggles, just being an entrepreneur,
sure,
family man, this and that. Last question. How do you maintain your work-life balance?
It's an elusive thing.
The myth of work-life balance, I should say.
Yeah. You just got to work on it. I think the big thing, whatever I do, whatever anyone else should do, is just always just aim for being consistent. If that means consistently battling at 50-50, 60-40, 40-60, being efficient with time. I think really time management. I talked a lot on the episodes that I have about calendars and time blocking, which is, calendars are starting to be super easy for me now. Time blocking can be a struggle. But be efficient with your time. So like yesterday, I had a block of time where I left and I went and did something with one of the boys because I knew next week it might be tough. Like fitting those things in, family or growth with the downtime, fight the urge to take a nap, stuff like that. But I think with all that too, one thing that I've tried to consistently focus on is, I heard a great thing a long time ago, and it said it's okay to take days off. It's not okay to have an off day, because the way that I show up is going to directly affect the way that my family is supported and how business goes. So if I can't be 100% or at least 80% on the phone, I push it, and say, hey, look, I have an appointment. Let's connect tomorrow. And maybe that appointment is with me. Yeah.
Well, when you leave here, and I appreciate you coming here, but when you leave here, you got to check out the latest episode. I put 30 minutes out on work-life balance.
Okay.
And I'll give you a spoiler. One of them is the power of no. Okay. So that's going to hit you all in your feels, Derek.
I've read about that.
So, Derek, how can people find you?
Facebook, Instagram, LinkedIn, TikTok. I'm the Derek Roban on Facebook and Instagram and TikTok, and the Nest Podcast on YouTube.
And that's spelled like Roban is spelled like Robin for out-of-state listeners.
That's right.
Derek, thank you, brother.
Of course.
Appreciate you, man. Hey, it would mean the world to me if you subscribe to the podcast and leave us a 5-star review. It helps keep the show free, and it helps us book better guests to provide more valuable content to you. None of the opinions expressed by my guests are that of my own, and nothing we talked about creates an attorney-client relationship or could be construed as legal advice. Hope you enjoy the show.
This podcast is powered by Acadiana Cast Network. Go to acadianacast.com for more South Louisiana sourced content.